financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Monday, October 10th. Here are the top market stories we're following for you at this hour. Retaliation risk. Putin threatens more missile attacks on Ukraine. Biden ramps up restrictions on the Chinese chips industry, increasing the probability of a response from China. And UK political risk. BOE rise to the rescue again, increasing the amount of gilts it can buy this week and expanding collateral to help liability-driven pension funds survive those higher rates. So pick your risk. Earnings season to inflation, to Ukraine, to chips, to the UK. We try and find the biggest risk this week and how to price it. From New York, I'm Alex Steele with Tom McKenzie in London. Guy Johnson is off today. Welcome to Bloomberg Markets. Tom, thanks so much for joining us. Pulling triple duty. I feel like we can have like a list at school, like of all the risks that are out there. There's so many. How do you trade off of them, I think is the question.
And to what extent we're becoming normalised to this BOE intervention? Yes, it's one of the most read stories on the terminal this morning, but it is remarkable just to underscore that the BOE has had to step in again. Of course, its operations expected to end on Friday. It's designing new tools to ensure there is adequate liquidity. That's just the BOE and the UK political risk. And of course, as you say, the geopolitics, what's happening with Ukraine and Russia, not to mention, of course, that data that we're looking ahead to on Thursday, Alex.
Yep, and you get the stronger dollar, you got the inflation data coming Thursday, and then you get earnings coming out. I mean, it's enough to make your head spin at that point. How do you hedge all of it? That really becomes the question. I should point out the semiconductor index falling another 3%. That's down almost 9% in just the last 2 trading days.
Okay, let's get to our question of the day then. What is the biggest risk event this week for markets? Joining us are Bloomberg's Christine Aquino and Jess Menton. Christine joining us in the studio here in London. What is your take? I mean, there's a lot for markets to have to work through this morning, and of course the hit already across the equity space as we weigh up all of these additional risks.
Well, Tom, I'm going to let my home bias guide me here and argue that it really is what's happening in the UK, specifically what the BOE is going to be doing with this program, these measures to support the bond market. I mean, if you recall, right, when the volatility first hit in the long end of the gilt market, that was something that reverberated across the entire bond market. I mean, everything from treasuries to European bonds were following the direction of the gilt market, and that's precisely because what we saw in the UK was essentially, in a lot of ways, the worst case scenario when you have the process of monetary policy kind of heading towards its tightening process. And then you got a fiscal policy, a bunch of fiscal policy measures that kind of went against the goal of reining in inflation. The combination of that really wreaked havoc on the bond market. And, you know, in a lot of ways, that was a lesson for a lot of the central bankers and the governments trying to navigate this very uncertain period. And so, you know, I would say what the BOE does next will be very important to watch for a lot of central banks out there. And it will be a great lesson in maintaining stability in the spirit of uncertainty.
Okay, fair. And like, will they ever be able to actually sell gilts? To be fair, sure, but I still think you should move to the U.S. Okay, Jess, help me out. Home bias here. What are you looking at?
So the big thing, obviously, is the batch of inflation data that we have coming this week. The big one is on Thursday with CPI, but obviously on Tuesday, we'll actually get the New York Fed's 5-year inflation expectations. Wednesday, there's PPI, and then after CPI on Thursday, on Friday, the University of Michigan has their long-term inflation expectation. So it's going to be really key ahead, especially in early November, when the Federal Reserve has their second to last meeting of the year. Already investors baking in that 75 basis point in that meeting, but depending on what happens this week, it's really going to set the tone, especially ahead of when we get the first quarter, or actually the third quarter GDP number. It'll be the first initial reading on that in a couple of weeks. So it's going to be a lot, and especially all of that coming ahead of midterm elections.
And Christine, we can talk about geopolitics, we can talk about Russia and Ukraine, but it's a reminder as well, the action on China and the hit that we've seen across the semiconductor space of how difficult it is to price in these deteriorating geopolitical dynamics.
Absolutely, Tom. I mean, whether it's in relation to Russia or Ukraine or the China situation, I mean, I think this is just a reminder that geopolitical risk is always simmering in the background, right? And it really is kind of the wild card that has plagued markets all of this year. I mean, we started start of the year, of course, not really having a lot of visibility in terms of China's economy, where they were going to go in terms of the lockdown progress, and then, of course, later on, the war in Russia, Ukraine, which is still going on. It is still kind of, we're seeing the reverberations of that kind of in different ways, whether it's energy markets or the gas situation that we're seeing now and how that's feeding into the winter energy crisis. And so, you know, I think that and markets are notoriously bad at pricing geopolitical risk as well. So that adds to the issue here.
Well, that's what I was going to say, is that if you hedged political risk before, you pretty much got burned anytime after Brexit. So it's like, is this time going to be different, Christine?
Well, I mean, Alex, I think, you know, investors have been burned time and again trying to hedge political risk. And this part of what's the issue in terms of market price action this year. I think, you know, we've had a lot of investors that have really been on the defensive side because it was difficult for them to kind of foresee how this all plays out, right? I mean, initially, right, we saw kind of a lot of energy plays at the start of the year, utility plays, but then once we started kind of seeing a few energy providers or utility providers going bust as a result of the energy crisis, that kind of fizzled out as well. And so this really just is a lesson in kind of trying to be prepared for potential geopolitical risks, but not necessarily also putting a lot of risk on the table, and hence, you know, the flight to cash that we've seen all throughout this year.
And hey, we haven't even touched on earnings. It's a massive week for earnings. They're going to be kicking into gear really towards the end of the week. Jess, what are you going to be looking for when it comes to the earnings story? Is this the next shoe to drop? Are you looking at an earnings recession, or does that come later in the year, maybe at the front end of 2023?
Well, the big thing is that earnings projections for the third quarter have come down so much. Right now, it's a little under 3% earnings growth for the third quarter for S&P 500 companies, and that's come down from nearly double-digit, close to that growth in those preseason estimates. So it's really not necessarily what exactly happens for those, because most likely companies will beat those expectations for the third quarter. It's more about what does the guidance look like and what does the outlook look like. And especially we're going to get a batch of banks on Friday, especially JP Morgan leading the way. But even ahead of that, we'll hear from Delta, PepsiCo, BlackRock. So it's really going to set the tone looking ahead, and especially looking at how a lot of the pain points, whether we're talking about dollar strength with multinationals, the spreading of margin weakness, and obviously those recession prospects for 2023, and especially just the barometer when we're looking at these big banks, whether it's some of maybe more of your Morgan Stanley and you're catering more to the higher end consumer, or say you're more of a Bank of America, and obviously that's more middle America, and we can really take the pulse of what the consumer looks like and consumer spending. So it's going to be really key to gauge what that looks like for the American economy.
So going back to the Fed point, though, just for a second. So yes, that's sort of like the micro up and then a little bit of macro factored in. For the inflation data, I'm wondering if we've significantly priced out enough of the Fed pivot.
Well, the S&P has dropped in 7 of 9 times with the CPI sessions this year, and the worst one was coming, the data point that we got in September. The S&P 500 was down more than 4%. So it's interesting to see exactly what that will potentially look like, because I think especially when you're stripping out and you're looking at more core and you're taking out what obviously those volatile components with food and gas prices, core continues to go up. And Mary Daly of the Fed last week was saying, don't expect us to be some sort of pivot anytime soon. And basically she was saying investors are confusing a pause with a pivot, because they could get to a particular restrictive rate and stay there for some time. But again, Charles Evans saying earlier this morning that there could be a potential scenario where they're able to beat inflation and still have the economy not go into a recession. But we will hear from Lael Brainerd later this afternoon, the number 2 at the Fed, and it's going to be key, especially that setting up into the CPI report, to see what exactly is she looking for in these kind of macro data points.
Guys, perfect setup for today. If your head's not spinning, I don't really know what to tell you. All right, Christine, Jess, thanks a lot. Christina Aquino and Jess Menton, great to get your perspective today. So coming up, we're going to continue the question of the day. What is the biggest risk event this week? Megan Hornman, Verdance Capital Advisors CIO, will be joining us next with her take. S&P up by 0.4%. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg Surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the
The
Fed.
data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, Thursday on Bloomberg.
Not only does it have to overcome inflation, but it has to restore its credibility. So yes, I fear that we risk a very high probability of a damaging recession that was totally avoidable.
That was Allianz Chief Economic Advisor Mohamed El-Erian speaking yesterday on recession risks on CBS. And that brings us back to the question of the day. What is the biggest risk event this week? Want to get the take with Megan Hornman, Verdant's Capital Advisors CIO. Megan, the list is so long. Earnings, inflation, geopolitical risk, Ukraine, Russia, gilt market. I mean, you name it, there's a lot. I'm sure I left a ton out as well. What are you watching most closely?
Yes, I know that a lot of people are focusing on the kickoff to earnings season, but earnings is really going to impact the market over the next couple weeks when the bulk of the companies will report. This week, I think the biggest risk is still the economic data. Clearly, there has been some rise in the geopolitical risks. That, I think, is taking a little bit more heightened risk to the markets this week than we've seen previously, but still the number one thing, I think, is the economic data. We have a lot of inflation information, we have Fed minutes, and then don't forget retail sales when we finish out the week as well.
So, Megan, what is the expectations? You're going to get an 8.1% headline print on U.S. inflation come Thursday. What does a number significantly higher than that do to these equity markets?
I think you get another lower in the equity markets. I think any of the optimism we've had to start off this quarter gets pulled out of the market in that respect. And I do think you'll see interest rates higher. Remember last month when we had a slightly higher print than was expected, we saw a lot of damage in both of those markets. So I think that could happen again if we get a higher print.
Does that mean that the Fed pivot conversation isn't yet priced out of the market?
Mm-hmm. Yeah, and I do think that the Fed pivot, I agree, I don't think is fully priced out of the market. I think there will be a little bit more clarity when you get these meetings, the minutes from their meeting. Let's get a little bit more understanding, not what's going to happen in the next meeting or the December meeting, but what they're thinking about in 2023. That's the biggest uncertain area that we have right now. You have people expecting the earnings recession to be pushed out to that point. You expect that we'll see maybe the economic recession, even though we're in the technical definition, to be pushed out to 2023. So I think that, yeah, there still is a lot of uncertainty there. I'm not sure that the pivot's completely out.
So, Megan, on that earnings recession call, where do you land on that question? If it's going to happen, what is the time frame in which you're looking at it?
I do think it's a 2023 story as well from just the earnings perspective, because keep in mind that energy is propping up the earnings right now. We think that'll continue this quarter. Earnings minus energy are supposed to be negative for this quarter again, but I think you'll see that energy support earnings for the next couple quarters. But 2023 is a very different story because eventually energy will be impacted by slower economic growth.
So based on that, where do you hide out?
Mm-hmm. So right now, we're not focusing on what's happening this week or next week or even through the rest of this year. What we're looking at is longer term. And when you have that ability to focus on the long term and your long-term objectives, then you can look at some of those areas of the market that have really priced in a lot of this weakness. Look at small and mid-cap stocks. We did see them actually get a little bit of a rebound last week, more than those large cap stocks, because this part of the market has really priced in what is expected to be slower economic growth and a challenging earnings environment.
What is the balance sheet's resilience, though, of small and mid caps, Megan, at a point of higher rates and some concerns and questions about lower quality corporate debt?
Right. So there's two things there. First of all, active management being very selective from the stock level in those areas is very important. It's important across all markets, but specifically in that small and mid-cap space. But what you have to look at, yes, small and mid-cap companies can be impacted by higher interest rates, and there is some concern from the lower credit quality and refinancing risks with higher interest rates. But what's been priced into the market? And there's been so much damage from a valuation perspective and price level that I think that it's pricing in a lot of that expectation. So there is chance more upside risk than I think downside risk in that area of the market.
Hey, Megan, what recession risk do you think is priced? What kind of recession is priced into small caps?
So I think a pretty significant recession is already priced in there. Not a 2007 to 2009 type of a recession, but I would say what we expect. We've already had the 2 negative quarters of GDP. We think it'll be challenging over the next year, but we don't think we're in for another. I don't think we're in for some sort of a 2007 to 2009 type of recession. The economy coming into this was still pretty solid. So when you look at the declines you've seen 40% across some of these small and mid-cap names, this is an area of the market that's pricing in somewhere in between a 2007 to 2009 recession and maybe a 1980s style type of recession.
Megan, on regions and sectors, we were talking to Goldman Sachs earlier in the day. They said there is a call around some of these European companies that have dollar exposure in terms of their sales, given what we're seeing in FX and dollar strength. They pointed particularly to luxury as an area of potential opportunity. Would you align with that view? Is anything in Europe looking attractive?
I do think Europe is attractive as a whole because that's similar to the small and mid-cap space. It's very underowned. Europe itself is one of the worst performing developed international markets that we've seen year to date. So I do think Europe as a whole, I still would be a little bit cautious on anything retail oriented because while there may be some of that, currency tailwind there for some of those European luxury makers, I still do think that there is just luxury overall will face challenges over the next year as consumers continue to pull back.
And then just kind of wrap that into the U.S. Stronger dollar, the downside, where's the biggest risk?
In the U.S., I still do think it's those multinationals are at risk. I think that when you look at the large cap area of the market, when you look at some of those very growth intensive names, technology, I still do think there's more room what we consider in this price discovery phase. We're going to get more information on that E part of the PE equation, but the interest rate environment I still do think is a headwind for that part of the market.
Okay. Megan Hornman, Verdance Capital Advisors CIO. Thank you very much indeed. Look at mid and small caps in the US, but you've got to do your homework in terms of bottom-up research. Coming up, the semiconductor index falls to its lowest since November of 2020. We're going to look at the latest tech curbs put in place by the US on China. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Shares of Rivian are falling. The electric vehicle maker says it will recall about 13,000 vehicles delivered to customers after discovering a minor structural defect. That's nearly all of the vehicles Rivian has delivered. A Boeing 737 MAX has appeared to make a commercial flight into China for the first time in more than 3 years. According to radar data, a Mongolian Airlines 737 MAX flew into Guangzhou today. China was the first to ground the MAX in March 2019 after 2 fatal crashes. It held off on allowing the plane's return long after U.S. regulators lifted their ban in late 2020. And shares of semiconductor companies are falling today. That comes after the U.S. imposed new curbs on China's access to American technology. The U.S. measures include restrictions on the export of some types of chips used in artificial intelligence and supercomputing. China says the measures are unfair and will also hurt U.S. companies. And that is your latest Business Flash. Alex?
All right, Ritika, thanks a lot. So let's stick to that semiconductor story. Joining us now is Woo Jin Ho, Bloomberg Intelligence, a senior analyst for hardware and networking. There's so much to parse through in this. Starting logistically, who is this worse for, U.S. companies and Chinese companies?
I think it's a zero-sum game, right? I think there are losers on both ends, both on the China side as well as the U.S. side. On the U.S. side, the U.S. companies do want to sell to the Chinese, but at the end of the day, the Chinese want to develop their own technology, and if they can't have access to that technology, the Chinese are losers as well.
Woo Jin, what does this mean, do you think, for the producers of some of this ultraviolet equipment, the likes of ASML over in the Netherlands? There's been a bit of lack of clarity as to whether or not they can continue supplying to China. Do we know if they can at this point?
Well, in the prior discussions with the U.S. as well as other semiconductor manufacturing countries, there were some restrictions in terms of the smaller geometry technologies. So I don't know if this is something that's new. But I think this is going to be something that's a little bit more definitive in terms of blocking these kind of technologies into China.
But what if there's a U.S. company that now can't get its parts from China in some capacity? What are they supposed to do? Selling their stuff is one thing, but what if they need something?
And that's a fantastic question, Alex. I think it's a zero-sum game again. For example, you know, there's a lot of focus on the higher advanced technology nodes right now. The issue is that China makes a lot of these commodity chips that the U.S. still relies upon, right? So if there is a quid pro quo, this could get really ugly.
Okay, so that's where the retaliation could come through from China. We're watching for that potential response then from Beijing. What do we know about the ability for China to weather this? We know they've been spending heavily on R&D around semiconductors and chips, but you also know there's been a number of missteps.
Yeah, so let's use Huawei as an example, one of the countries that is on the entity list, and essentially what the U.S. has done during the Trump era is essentially ban semiconductor chips or access to the U.S. semiconductor technologies for Huawei. What has happened is that their smartphone business has essentially withered away and has gone to other companies within China that had access to the chips. Now the issue is that now we're talking about a countrywide ban that won't have access to these advanced technologies. And look, I wouldn't say it could slow down the AI capabilities of China over the long term.
Woo Jin, what's the downside for the semis then? I mean, the SOX index is down like 9% in 2 days. There's also broad demand worries in general, unrelated to any of this battle between the U.S. and China. What is the downside here?
Well, really tough to say right now because to your point, there's a lot of macro news that's hitting the semiconductor names as well. You got the consumer pullback that's curtailing AMD sales and demand, at least over the near term. For the long term, you know, NVIDIA is saying that it's not going to hurt them, and you know, it's still a wait-and-see approach in terms of what this will entail. Right now, we have to keep in mind that some of the AI chips into China is still fairly low, and there is some access to some of the older generation chips that China can gain from AMD as well as NVIDIA to bypass some of these sanctions.
Yeah, and on the Chinese side, I thought it was fascinating to hear from He Xiaopeng, who's the head of XPeng, one of the big EV makers, startups in China, saying this is going to impact them as well, potentially. Wu Jinho, fantastic. Thank you for that analysis. Bloomberg Intelligence senior analyst on these additional curbs put in place by the Biden administration on semiconductors to China. Coming up, oil's rally stalls on slowdown concerns. We're going to discuss with Ed Morse of Citi next. Also get his views on copper and gold. Stay with us. This is Bloomberg.
We're about an hour into the U.S. trading session. I really feel like it's hard for stocks to find direction right now. Nothing's really moving except the bond market over in the U.K. Bloomberg's Abigail Doolittle is tracking some of those moves for us. Abigail?
Yeah, good point, Alex, because right now we're looking at a very small decline for the S&P 500. A fourth down day, though, so that downward trend continues. Last week was overall an up week for stocks because of the big rally on Monday and Tuesday, but nonetheless more declines. You can see bigger declines for tech, and especially for that stocks, that chip index now down more than 40% on the year, so a real bear market there. It's also at its lowest level since November of 2020, right now down 3.2%. This, of course, is the U.S. Commerce Department is really putting in curbs against China tech. That is big. That is weighing in a big way. And we also have oil up just slightly, but it is above $90 a barrel. So an inflationary pressure on stocks, given the fact that it could create some demand destruction. As for some of the fallout from the China tech curbs, we can see here that semiconductors just across the board continue to get slammed. Last week on Friday, it was AMD down 13% after pre-announcing sales, but we can see Lam Research. That is a cap equipment company. They make the machines that make the chips, so this is a real leading tell on a leading sector, and weakness for some of these other names. So these stocks, these chips, just cannot get a break. Speaking of not getting a break, and also maybe a roadmap on what's ahead, if we take a look at China Tech since the 2021 peak, this is not the true peak for the Hang Seng, but in white, this is the Hang Seng from March of 2020, right around the time that we had those big crackdowns on technology. And over this time period, down 60%. What we're looking at here in red then is the stock 600 technology. It's down 18% over that time period. Then in blue, you have the S&P 500 techs. In purple, outperforming, interestingly, down 2.5% is Japanese technology. But the interesting question here could be not so much that the China Tech and that Chinese stocks are underperforming so much. Is this a roadmap for what's going to be happening here in the U.S.? We don't know that for sure, but it certainly is a big drag. It's hard to see the world's two largest economies continuing to trade at such a divide, Alex.
Yeah, really good point. Abigail, thanks a lot. Really appreciate it. Some breaking news for you. Germany is backing a joint EU debt for loans to tackle the energy crisis. This to me seems quite significant, Tom. There was the conversation last week among finance ministers, and some wanted joint debt issuance. Some, like France, wanted a kind of middle road, and the accusation was that Germany was going it alone with its 200 billion euro rescue package. Now it appears as if Germany is backing joint EU debt, which is, unbelievable considering where this conversation might have been a few years ago.
I think you hit the nail on the head. Yeah, the Germans faced a lot of pressure just over the last few days, exactly on that point. They looked like they were going it alone with their own significant fiscal spending, I think plus 30 billion euros. Now, yeah, within the context of the European Union, to see the Germans coming out and saying we're going to have joint debt around any topic is remarkable. Of course, there is something of a blueprint in terms of how they tackled the pandemic and spending across that. But this is absolutely something the Italians were pushing for, the Spanish, the Greeks as well. So absolutely, this is significant. We'll wait to see what the details are. But this pivot from the Germans and what this will mean for the energy complex. Unity is what they've been stressing, and it seems like they're closer to that now, Alex.
Yep, and this comes as an independent commission over in Germany said that Germany needs to spend almost 100 billion euros to subsidize natural gas consumption on an industry level and consumer level as well. Should point out that the sell-off in the bond market is holding firm over in Europe. You have bond yields up by about 1 to 2 basis points, Italy up about 7, so that BTP bond spread widening out by about 250 basis points, Tom.
Yeah, and here in the UK, gilts as well. The sell-off quite pronounced across the curve. In fact, a 30 basis point move at the front end. On the 2-year, 447. On the 30-year, 4.7. That's a move higher of 32 basis points. Yes, the BOE came out with an additional intervention, but what they also reaffirmed was they're going to be stepping back from this program, of course, that they set up on the back of the financial roiling that we saw on Friday. We know the Chancellor's trying to assuage the markets by bringing forward his fiscal plan. So far, it's not working, Alex.
Yeah, definitely not working. And the BTP bond spread I was just mentioning, now going to 236 basis points. That announcement from the headline from Germany there backing that EU debt issuance seems to be somewhat working. All right, let's get back to the risk story today. So what was our question that we're asking all the guests? What is the biggest risk event this week? We're going to get the latest read on U.S. inflation on Thursday with the CPI, plus you get retail sales, UMISH, PPI, and a big part of that inflation figure is attributed to the rising cost of oil and energy. So here to talk about that volatility, Ed Morris, Citi Global Head of Commodities Research. Ed, give me your price call for oil after OPEC Plus seems to really want that $90 level as a baseline here.
They do, and it seems to be holding for a while, but we'll wait and see. We've got a lot of oil in transit at sea, and that's what's going to be hitting the market for the rest of the fourth quarter. The cuts that start in early November are not going to be felt in the market until January. We have volatility because on the one hand there is a lot of oil sloshing around in transit and in the world's waters, but on the other hand we have Europe having this December 5th deadline to get off of Russian oil. They've already gotten, in terms of seaborne oil, they're down 60% from what they were a year ago, and we expect the rest to be off, or mostly off, at the end of the year, and that should, along with the OPEC cuts, put a bid on oil prices.
Ed, you've got a call of $75 by the end of 2023. What depth of recession and slowdown is that number and that target pricing in?
Well, that did not price in, by the way, so it is our current forecast. But when we did that forecast, we did not count on the OPEC cut. I'd say we've got to pay a lot of attention to the OPEC put now, and I put that OPEC put at the $85 level.
Ed, when we get towards December 5th and we see a cutoff of Russian oil to Europe, or if we get an oil price cap or a gas price cap, is that bullish or bearish for the commodity?
It's actually bullish for the commodity because it means that Europe has about 1,000,000 barrels a day, 1,200,000 or 300,000, that they're not going to be importing from Russia 2 months from now. And they're going to have to buy it from someone else. In order to buy it from someone else, they have to bid up the price of other things. And among the other things they have to bid up is the price of WTI, because that's what is available in the free market.
And Ed, you talked about the OPEC Plus put, that surprise 2 million barrel cut. You say it's not going to hit until January. What is the ability, how much scope do they have, OPEC Plus, to further cut output should they need to do that? How much consensus is there within the group?
Oh, there's not much consensus at all. I mean, the only countries that can really cut are the UAE and Saudi Arabia, Kuwait a little bit. Iraq could cut, but their history of doing this at times like this are not very good. Even if they don't comply, compliance for the group, because of the way they do the numbers, will be a couple of 100% above where they should be. But yeah, the OPEC cut of 2 million barrels a day is certainly less than 1 million. Some people have it at around 500 a day, all things considered. It's probably somewhere between 500 and 900. 900 a day is a meaningful amount of oil to be taken out of the market. But it's a noisy market with the world in an economic slowdown and potentially moving into recession.
Yeah, exactly. So that's sort of like the supply side of it, and there's the demand side of it. How do you see the demand side evolving if we're in a global recession, if China doesn't come back? How do you model all of that uncertainty?
All of that uncertainty is really about 3 million barrels a day.
That's a lot.
So that's an awful lot. And China is 1 million barrels a day of that uncertainty. The U.S. was down in demand in August versus last year on weekly numbers by 2 million barrels a day, and Europe is certainly down. So demand, it's down because of oil prices being high, and we'll see whether that elasticity is going to come back into the market at a lower price. It's a very open question.
Ed, it's not clear what China's going to do at this point in terms of COVID zero and the removal of these barriers around their borders. But if we get, hypothetically, China removing those border restrictions and reopening in the second half of next year, what does that do to oil?
Well, it means that there's an awful lot of new jet fuel demand in the world, among other things, but I say jet would be the big pull. China is down tremendously on jet fuel demand. We're still around, over 1 million barrels a day below where the world was in 2019. China's about half of that, and that would be a substantial pull on the middle distillate environment.
Flip it though, Ed. If your uncertainty about China and demand for oil persists, what does that mean for the commodity-sensitive stuff like copper, for example, or base metals in general?
Well, copper is moving to a China tune recently. We're seeing base metals really slipping because of what's happening or not happening in China. It would take by the end of 23 to see metals prices really moving up. And when they start to move up, we think that they'll be moving up for a while because metals demand is going to be increasing as the world turns greener and as we have more demand for battery power and wiring and the like. But at the moment, the lack of the margin of demand coming out of China has dropped prices down below the marginal cost.
Ed, towards the beginning of this year, there's a lot of focus on those refining margins. Are they as good as they've been? I mean, is it all downhill now for those refining margins?
There is a big China pressure making them down on the downhill. There's, of course, a big refinery strike keeping them up a bit in Europe at the moment. But when we look at China, they cut out exports of transport fuels about a year ago. That includes diesel and gasoline. They were exporting about 1 million barrels a day of that. They've started to come back. They're now exporting about 400,000 barrels a day of transport fuels. But with the new export licenses that they've been given to refiners, we can see that export number going up to maybe 1.2 million barrels a day. 700,000 of that would be distillate. We've already seen as a result of what they've done so far, a crash in distillate margin in Asia. They're coming down elsewhere in the world. But, if China gets up to over 1 million barrels a day, of product exports, it would really put pressure globally on those refinery margins.
So, Ed, the scenario that you are laying out that we could see would actually be quite good for the global inflation picture. I mean, softer prices, if China's able to ramp up exports of diesel, etc. Is that fair to say on the whole that is, like, how soon could that picture turn?
Well, we've had the picture turn in reverse because of the surprise level of the OPEC cuts. But, you know, we honestly think that the world is going to be seeing inventory builds in this quarter and inventory builds next year. So if the recession gets worse, those inventory builds are going to be bigger, and we'll see whether the OPEC plus countries have anything in it to you know, support a $90 price. They certainly like $90 oil. They made no bones about it, but getting there in a recessionary environment may be quite hard.
Okay, if we get lower inflation, does that give a bid to gold then, Ed? Down about 10% year to date.
If we have expectations of lower central bank, including the Federal Reserve Bank's hike rate increases, then yes. At that moment in time, we're going to see the gloss back on gold. Gold has been fluctuating a lot lately, partly because of where the inflation numbers are, partly because of uncertainty about what Fed policy is going to be. We get back to a lower level of, or an evening out, or reaching of a peak of Fed rate increases, and gold will certainly shine.
Okay, really, really interesting. Ed Morse, Citi Global Head of Commodities Research. Thank you. Currently, WTI at $92 a barrel, just up 0.1%. Brent at 97.80 currently as things stand. Coming up, we will look at how hikes by global central banks are hitting emerging markets. We're going to discuss with private equity manager Oscar Decotelli, DXA Invest CEO, with a focus on Brazil. That is next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Russian missiles hit Kyiv and other Ukrainian cities today in the most intense barrage since the early days of the invasion. And Vladimir Putin threatened further attacks, warning that the action would be harsh. That came after Putin blamed Ukraine for an explosion that damaged a key road and rail bridge connecting Crimea with Russia. Ukraine hasn't acknowledged it was responsible. Former Federal Reserve Chair Ben Bernanke and two U.S.-based colleagues share this year's Nobel Prize in Economics. Bernanke, Douglas Diamond and Philip Dybvig were honored for their research on banks and economic crises. The Nobel Prize Committee says the three improved the understanding of the role of banks as well as how to regulate financial markets. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Alex.
All right, Rika, thanks very much. Let's get back to one of the main stories, the economic data and the Fed. You got Bloomberg opinion columnist and former New York Fed President Bill Dudley saying the Federal Reserve has some work to do to rebuild its credibility with the markets. Here's what he had to say earlier this morning on Bloomberg Television.
Powell has now endorsed the notion that there is going to be some pain involved. I think what the Fed has not done, though, is admitted how do we get into this mess in the first place. The Fed's strategy here is not to just keep hiking regardless of what's happening in terms of the real economy. But I think they want to go to a restrictive policy, and then they want to hold it there until they see clear signs that that's actually bringing inflation down and generating more slack in the U.S. labor market.
And Charlie Evans saying something very similar in a speech earlier. He's also talking to reporters right now in Chicago saying they're on track to impose a lot of policy restrictions and they see rates around 4.5% by March. Okay, that's a stronger dollar story. It's a higher rate story, and that feeds through to one potential risk, of course, emerging markets. Well, joining us now for more on that topic is Oscar DiCatelli, DXA Invest CEO. He's a private equity manager primarily focused on Brazil. Oscar, let's start macro. First of all, good to see you.
Thank you. Good to see you.
For macro, as the Fed keeps raising, what are you noticing on the ground in Brazil in terms of trauma for EM assets?
Well, it's very interesting because what we're seeing is that maybe for once there's a silver lining in Latin America. First of all, we've always been used to higher inflation, and this whole game or play that's happening out here, we're very used for decades, right? And it's funny that we're going to see probably specifically Brazil's going to grow this year probably higher than China and have a lower inflation than the U.S. Could you ever think about that?
Nope.
So I think what we're really seeing is that there's a bigger movement happening of sound economic trends happening across Brazil, for instance, independent of who the president is, but really kind of, I think that what we're seeing on the digital transformation, that's really what drove the U.S. about 15, 20 years ago. We're now seeing that happen in Brazil and across Latin America. That's not really going to change because of macro.
Okay, Oscar, you talked about the politics. What are the political risks? What do the markets want to see, either from Lula or from a second-term Bolsonaro?
Well, Tom, I think it was very interesting to see on the first round. We saw the Senate and the lower house basically all tilt to the right. I think that was very positive to show a lower volatility in the scenario, that some of the economic decisions that were made, such as the reforms that were done, we're going to see that kind of being maintained because it's going to be a lot harder for even if Lula is a president to change that. And with Bolsonaro as president, we're going to see a path towards a continuation of this kind of more liberal approach. So I think the first round was very good for Brazil, so we could see lower volatility in the horizon.
So you mentioned it a little earlier, but what sectors then are political dollar proof from your point of view?
Good question. Well, I think if you add to it the geopolitical risks that are happening around the world, right, and you look into commodities, for sure agro and commodities in Brazil are very strong sectors, right? If you look at, for instance, Ukraine and Russia, the whole wheat and corn issues, that's going to favor Brazil because only other countries like Argentina or even the U.S. could potentially tap into that supply chain. So I think we're going to be able to see agriculture as a very strong sector, but also any kind of digital related type of assets, we're going to see it also. So if it's either consumer related or even in the financial world, fintech type of angle, also we're going to see that quite strong.
Oscar, what about the iron ore hit, though, from a potential recession? Surely that is one negative headwind that Brazil would be facing.
Yeah, I think so, but I think that's still kind of more of a major play, right? So I think on the iron ore side, there is some discounts to comparables around the world. I think that we're going to see really is kind of the macro play in terms of making sure that volatility coming down and Brazil kind of coming up in certain of these changes in the demand for agricultural goods.
The other part of this is what the private markets are like. I mean, you're a private equity guy, small and mid-sized companies. What's it like to either fundraise right now? And what is the broader risk of, as more financing moved into the private market, it feels like that's where people are talking about the risk is as we get higher rates and a stronger dollar. What are you actually noticing?
It's quite strange because when we see LATAM and Brazil, it's been so much lacking behind to the rest of the world in terms of capital towards privates, right? So if you compare to the percentage of GDP that are kind of digital companies, right, we're still seeing Brazil, for instance, maybe 15 years behind the U.S. as a percentage, just even a LATAM like 3%. So compared to the US, it's like 50, 55% of the GDP. Or even India. If Brazil and LATAM were to just to match up to what Indian levels are, we're talking about $800 billion being invested into that specific sector.
So there's the digital catch-up. To what extent is Brazil kind of an idiosyncratic story, Oscar? What other parts of LATAM would you add to your list after Brazil?
Look, definitely what we're seeing in these last years has been the transformation around open finance and around fintech. Instant payments, for instance, in Brazil, what we call the PIX, right, became the #1 use for transfers. That same technology is coming to Colombia now. So I think banks like Nubank, for instance, are going to be definitely big winners in this whole sector.
And then to that point, but on the flip side, exiting positions, what's that like right now in this environment?
Yeah, I think it's a little bit a bit more difficult given the whole liquidity around the world. The world was addicted to liquidity in a sense, right? But I think that most investors have such a small percentage of their portfolios exposed to LATAM. LATAM is 9% of the global GDP, and most people either don't have any kind of exposure to the region, or they might have 1% or 2%.
Which is different than other times when the Fed has really put pressure in the currency market, for example. Hey, Oscar, it's good to see you.
Great to see you.
It's been too long. Oscar Diacatelli, DXA Invest CEO, joining us. This is Bloomberg.
Okay, let's check in on these European markets then. Across the benchmark, you're seeing losses of 0.3%. The focus, though, firmly was happening in the gilt markets. Back again in the UK. The markets are not reassured by the BOE intervening once again. They're going to be ending their program on Friday, but they've retooled their support in terms of liquidity for these markets. But nonetheless, a significant sell-off, particularly at the long end. This is the 30-year, a move of 32 basis points. That's the biggest jump, the third biggest jump in a decade, putting pressure back on the BOE, but also the Chancellor of the Exchequer, who says he's going to bring forward his fiscal plans along with that important analysis from the Office of Budget Responsibility. In Europe, the European Union, the euro, I should say, down 0.4% as the European Union coalesces around an idea on debt for energy and the energy crisis. It's a significant move. The Germans are backing this, and you're starting to see some action across the yields in Europe as well on the back of that. The euro, though, down 0.4%. At the close coming up, of course, Jordan Rochester. We're going to get the FX calls from the strategist at Nomura. This is Bloomberg.
On Bloomberg.
It is Monday, the 10th of October, and the countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
The benchmark here in Europe, the Stoxx Europe 600, currently down 0.2%. There's a little bit more optimism in Germany. There's a plan there around energy caps and an EU-wide attempt to address the energy crisis. But broadly, you're seeing those losses of 0.2%. The fear factor is really within what's happening in the gilt markets once again here in the UK, particularly at the long end. Across the curve, there's been a significant sell-off, but the 30-year currently the move higher of 32 basis points, 471 on your 30-year, despite the BOE intervening. Once again, they're going to be pulling that program on the 14th, but they've retooled it around the liquidity support for the pension funds. The expectation is the BOE is still going to hike aggressively on November the 3rd. The Chancellor under pressure and the BOE determined, it seems, to get those rates higher in this inflationary environment. Euro, dollar currently trading at 97 cents on the euro. That's a drop of 0.4%, even as you get some movements in terms of addressing that European crisis around energy. That is the shape of these markets as we head towards that close. 28 minutes away, Alex.
Yep, so where do you go? You go to the dollar, apparently. Euro dollar, that cross, really front and center for that. So here in the U.S., stocks not doing so well. Rolling over, S&P now down by 0.8%. Definitely the lows of the session. Now you have the stocks, which is the semi-index. That's down 5.4%. That now brings the two-day slide for the stocks to like 11 or 12%. Really ugly. Skip this one for a second. Go to the NASDAQ 100. Now we haven't seen these lows for the NASDAQ 100 since September of 2020. And the reason why, you got Broadcom, you got NVIDIA, and Qualcomm are the three top holdings, three of the top four holdings in the NASDAQ 100. That's a semi story. That's a China versus U.S., basically this economic pain story. Now, that brings me to this. This is the TLT. This is the 20-year plus Treasury ETF. And I'm using that as a proxy because the bond market here in the U.S. is closed. This measures price. Price lower, yields higher. Price lower, yields are higher. We don't know how much higher, but we're now looking at almost 2% downside here. We're not seeing any kind of love in the Treasury market, not seeing any kind of love in equities. It's really just now for the dollar, Tom.
And I want to bring it back to the UK because, of course, the dollar is an impact there. In fact, the Chancellor would like you to think it's all about the dollar when, of course, it is also about their fiscal plans. Investors do not think that the BOE's intervention to calm the markets are enough. The Bank of England extended emergency measures backing the bond market through early next month. Meantime, Chancellor Kwasi Kwarteng says he will set out his fiscal strategy on October 31st. That is almost a month earlier than planned. Joe Mays, our UK government reporter, joins us now for more. Joe, what do we know about the Chancellor's plans to bring this forward? There'd been this back and forth around when he was going to release them and detail them, and the importance of the OBR and their estimates as well, Joe.
Yeah, this isn't something Kwasi Kwarteng wanted to do. As recently as last week, he was saying they were sticking to that November 23rd original date for publishing. But now, under pressure from parliamentarians, from the city, he has brought it forward to October 31st. In that attempt to assure markets, but also noted today the appointment of a new permanent secretary in the Treasury replacing Tom Scholar, and the candidate they've gone for, James Bowler, was again not the first choice of Kwasi Kwarteng, but they've gone for a Treasury veteran because again they felt they really need to restore their economic credibility. They've gone for that safe option for the new head of the Treasury.
Yeah, but you know, a couple more weeks we still have to wait here, Joe. I'm trying to get an idea of the BOE's move today and how it relates to politics. Is it about giving more breathing room to the government? Is it about saving the housing market? Is it about saving pension funds? Do we have an idea of that yet from your side?
It feels like it's all of the above. You know, it's really providing that support to the bond market so the government can have some breathing space economically. We know it's been so tough for them lately. They're trying to kind of bring out all their weapons to reassure markets, restore that credibility in UK assets, because that was what was sorely lacking in the last few weeks. But as we've seen with the bond yields moving today, it's not having the total desired effect. So I think expect more of that to come ahead of that likely BOE rate hike.
Okay, Bloomberg's Joe Mays, thank you, as ever, for getting us up to speed on what's happening with the UK government response to all of this. Joining us now is Jordan Rochester, Nomura G10 FX strategist. Jordan, so you've had this intervention from the BOE earlier today, the Chancellor pulling forward his fiscal plans. Are you reassured?
Not really, no. I don't know any serious, credible investor that needs the OBR forecast to help them trade gilts. I don't know anyone who says, I need the OBR to help me out here. But I think what it does show is the government is willing to move quicker, which was kind of expected after the recent U-turn on the tax cut. And also, we just need to know the question, what is your GDP forecast assumption for the OBR? Is it too rosy? In that case, these forecasts for gilt issuance, they're not high enough, essentially. Number two, I plan to do spending cuts in the future because that's the only way I can make sense of it. You've got this huge energy package, these national insurance tax cuts. How are you going to square the circle? How are you going to follow any credible fiscal rule? I've seen many budgets come and go. The pound's never cared. This was the first time. So this is probably the first time I've seen the OBR forecast get any attention for sterling investors. It probably means that we see the forecast, we doubt them, and we carry on.
So if I look at just straight up 10-year yields over in the UK, up 28 basis points, can I say something like, oh, what the BOE did announce today didn't actually work, or is it way more complicated than that?
I don't think it's complicated, Alex. It's just essentially the Bank of England wasn't there to calm down yields, to help people owning gilts make money. It was essentially to smooth the transition for pension funds. It was the pace, it was the change, it was how fast yields went up that made it very difficult for pension funds to meet their margin calls, essentially. So it was a two-week stopgap, which allowed them to kind of get themselves in a better position cash-wise. Those who didn't have good repo lines to set those up, and for some security, today we've had the Bank of England announce an enhanced repo line as well. So this all makes the functioning of the market better than what it was, but I don't think with inflation near 10%, the Bank of England wants yields to go materially lower.
Market's pricing in between 100 and 125 basis points from the BOE on November the 3rd. Does that put your parity call at risk?
Well, if anything, it makes it more likely.
Does it? Okay.
Why? So there's two reasons. One, growth is everything for foreign exchange, trade flows. So when you're hiking into a recession, the more you hike, the bigger that recession's going to be. Makes sterling less attractive. Why would you buy FTSE 250? Why would you buy gilts when you've got this uncertainty for your economy? And second, I don't think they'll do 125. It'll be more like 75 or 100. So whatever happens, I think the Bank of England will probably disappoint markets on the day. Sterling heads lower, and we still have the same story. This just makes the recession even worse. Why would you want to own UK assets?
Okay, parity. Let's get back to that point, because a week ago it would have been like, oh, okay, we're pretty close. Parity makes sense. We're at 110. When do we get to parity? And is there going to be another trigger, or is this like a slow deterioration kind of thing?
Well, the UK kind of needs parity in sterling. Sounds awful to say. We all go on holiday. We don't want that when we go to New York. We don't want $5 to be £5 when it comes to buying a Starbucks coffee. But the UK and Europe are suffering from a terms of trade crisis. The price of our imports have shot through the roof. And now, when it comes to our exports, relatively uncompetitive. The price of electricity is 6 times higher in the UK and in Europe than America. It makes American manufacturing really competitive. So we do need that currency devaluation to help out our exports. And then when it comes to the overall story, we are in an energy crisis. America has what we need. It has oil, it has gas. The trade deficit for the UK and the Eurozone will keep getting wider. That drives sterling low. So this is very much a winter story. I think we go down to parity, we go to 97.50 by year end, but it's not carrying on from there. Hopefully we have a cyclical rebound, energy markets calm down, and from March of next year we have a softer dollar, and that also times with the view on the Fed. Maybe from February and March the Fed gets a bit dovish and stops raising rates at all, or just at a slower pace at least, and that will allow for a softer dollar and sterling to recover.
That's really interesting. So February, March is when you're looking at potentially softer dollar. So take note, Alex, because I know she's looking at a shopping spree in the UK. She could buy up a small county at this point when we get down to parity. Alex is going to be here. Buy a small county and a couple of old castles. Jordan, in terms of the inflation data on Thursday out of the US, the fundamentals around the US dollar, and you just outlined the energy and the relatively resilient economy relative to others. If you get a significantly softer print, I think 8.1% is the forecast, does that take a knock to dollar at this point?
Absolutely. I think this core inflation number determines the month, okay? So if we have a weak number, let's imagine it's 0.0% month on month. The market's looking for about 0.4. Dollar softens big time. We're talking 3 big figures, I think, in Eurodollar and cable 4. But then that doesn't mean the trend is that we have a dollar softer story. It just leads to lots of emails about why it could weaken. This is peak inflation. But I think the labor market is still tight in America. And let's look back at the last inflation number. The horror show was that all of the leading indicators suggest it should slow down. But then we started to see firms that have raised wages passing that on to consumers. And that second round effect of inflation, that's what's driving core CPI higher at the moment, along with housing as well. Those two combined means I doubt we'll get a very soft number at this stage.
Okay, so we're going to talk about that next. Jordan, stay with us. Jordan Rochester of Nomura. Sticking with this, we'll talk about that inflation data and also what to expect from the dollar. Plus, we're going to take a look at the impact of Germany's support of joint issuance on EU debt to deal with the energy crisis. And I just have to point out these moves in the bond market since that headline crossed. You have German bonds up by 14 basis points, French 10-year, so the oats up by 12 basis points here. And now you have Italy, some buying actually starting to come in a little bit. Yields are now flat. That just exemplifies what that headline meant in terms of joint issuance. We'll break it down in a moment. This is Bloomberg.
Tomorrow, Bloomberg has the biggest names in business. Bloomberg Invest New York, where industry leaders discuss the challenges and opportunities in today's changing economic landscape. Coverage begins tomorrow, only on Bloomberg, your global business authority.
To that breaking news, Germany backing joint EU debt to address Europe's energy crisis. A huge reversal for Chancellor Olaf Scholz after a long-held position against the use of common borrowing. Let's get more on this with Bloomberg's John Filane. John, we are seeing the move in the market, in the bond market, is huge. You see BTP bond spreads really coming in about 20 basis points from the wides of today. Walk us through how this happened and what we're talking about here.
Sure. Well, look, I mean, I'd go back. The origin of this is the European Union summit in Prague last week. First, off the record, we had sources briefing about their, frustration, even anger, at Germany's massive 200 billion national aid plan, which they said was a lack of solidarity. And then we had the leaders coming out as well. And basically since then, it's emerged that the German government is actually ready to back going across the EU on a debt plan, as long the one condition is that it's for loans, not grants.
Yeah, they have to apply that conditionality, don't they? But still, a significant shift. John Filane, thank you very much indeed, of course, of Bloomberg, breaking down that story in terms of the shift from Germany and the rest of the EU on support for energy across the Union. Let's get some perspective now when it comes to the FX space and the read across to the euro. Jordan Rochester is still with us, Nomura G10 FX strategist. And Jordan, hello.
Hello.
I'm melding the two. The euro is currently down. The euro is currently down 0.5%, 96.94. What does this mean for euro?
Hope moves markets, but facts determine reality. So the reality is, as the reporter just said, loans, not grants. If this was grants, this would lead to massive tightening. In peripheral spreads, we've seen euro rally a little bit on this headline, but it doesn't really change the euro story because this is just the EU issuing rather than Italy and elsewhere, where actually the trade balance will still be wide, the US will still have oil and LNG exports. It doesn't really change the euro area story, but for individual countries, it makes the issuance a lot easier, so they'll have less of their own issuance to do, the EU will take up some of it, so therefore you have higher credit ratings attached to that issuance. But overall, for currency markets, little of a difference. For rates markets, an interesting story.
Yeah, I mean, I know the FX guy, but like I mentioned earlier, we're seeing pretty solid moves in the bond market in Germany and in France. And I'm wondering if there was joint issuance, like what yield would that be? How does one go about figuring that out?
Well, you take the credit rating of the EU for a start, compare that to comparables globally. And that's essentially how you do it, Alex. So it's in the SSA space rather than in the FX space. I can't comment too much on that, but essentially it will trade tighter than the likes of Italy, Spain, Portugal and Greece. That's the main thing. Helps lower the overall average cost of borrowing for the euro area slightly, but as you saw on that last chart, euro popped higher briefly on the headline, then reality came back. Loans, not grants. It's not that big a deal for the euro FX market.
Okay, you have a call of 0.90, and 90 cents on the euro by the end of the year. What would change that? What would you have to see from the ECB? Is it the ECB you look to change up, or is it the energy markets?
ECB, absolutely not where I'm looking. So the more the ECB raise rates, the bigger the European recession will be, therefore euro is less attractive. So the ECB hiking rates to defend the currency, the Bank of England doing the same in the pound, not helping guys, so don't take your focus away from there. The main thing is US rates. So the question we have to ask is, will global growth recover? Therefore, we can talk about buying euro, buying pound. That's one aspect. Or has inflation peaked and will the Fed react and get dovish? That's the other one. I think that's the more likely one of the two. I'm looking for a global growth rebound. I hate being Mr. Doom and Gloom. I want to talk about something positive. Maybe we see the US consumer bounce back. Gasoline prices have softened. Consumer confidence bounced back in the University of Michigan, the last number. If that becomes a trend, maybe actually this has all been overblown and the US is doing well and growth expectations improve. China might relax their zero COVID strategy. All these things could happen, but that's not the state of things right now.
Right, and then that in essence would mean some kind of dollar peak, but it also feels like every Fed official that speaks is in no way saying that. I'm just pointing out to Chicago Fed President Charlie Evans in a speech in Chicago said that I see the nominal funds rate rising a bit above 4.5% early next year, then remaining at this level for some time while we assess how our policy adjustments are affecting the economy. That's get there fast, front load, and stay there. How does that then in any way become a pivot or a pause for the market?
Well, the market's always trying to predict and price in what comes next. So we're looking, for example, for that to not be 4.5, to be more like 5.25 to 5.5. So there's an extra 100 basis points above what he was talking about there. That's a lot of dollar strength to come. But if they were to pause, that means everyone then thinks, well, what's next? The direction for most people in this market will be rates are heading lower. When? So when that pause comes, that's the Fed pivot. And the question is, how quickly will they cut rates and why? If it's due to defaults, then it's a quick rate cutting cycle, pretty aggressive. If it's just a bog standard normal slowdown, then maybe we have 25 to 25s, which is what we expect from September of next year. But I think in all, Alex, that's the moment you have the dovish pivot, and maybe that's when we get peak dollar.
So before that, until then, where else are you hiding out other than dollar?
Well, things have become a lot tougher with lots of central bank intervention. A lot of people would say RV trades are the best way to do it rather than the broad dollar trend. So we like CAD versus the likes of Aussie and Kiwi, connected to oil prices. Its biggest partner is, of course, the US. So you have a nice correlation there, stripping out some of the dollar.
I know you're G10, but walk me through emerging markets. Are they as much at risk as they have been in the past to the stronger dollar?
While developed markets are at risk just as much as EM at this stage, I think what we're not seeing is EM selling off as aggressively as DM, which is pretty interesting. I think that's because EM's been a bit more aggressive when it comes to their interest rate hikes compared to previous cycles, and also because we're just not in the same balance payments crisis for those places, because this is a Ukraine-Russia story in Europe, not something that's happening in Asia. But they can't avoid the fact that global growth is slowing down. So it is pretty difficult to find a place to hide. But there has been a notable divergence between DM selling off quicker versus the dollar than EM.
Does that CAD call rely on plus $90 barrel oil? How are you thinking about the oil price in that call?
I've got a pretty strong view that energy prices are not going to soften that much this winter. 5th of December, we've got the EU sanctioning Russian oil, crude oil. That's 1 to 1.2 million barrels a day. We've got the SPR released by Joe Biden. Does he extend it past the 21st of October? Yes, let's imagine he does, just past the midterms. So we've got tighter oil markets from the 5th of December and when that SPR release comes to an end. Then you've got natural gas. The US natural gas market will become a lot more correlated to what happens in Europe. So I think there's a stronger energy story from the supply side. The demand side, I'm not too concerned about. It's slowing down, but not as quickly as that EU sanction will be on the 5th.
No, fair enough. Hey, Jordan, we really appreciate it. So much news to get through. Jordan Rochester, Nomura G10FX strategist. Thank you so very much. All right, coming up, the UK's financial watchdog is looking into banks' use of WhatsApp. And you know that there's always fines that come after that as well. Details next. This is Bloomberg.